Hello and welcome back to the Note. Let's move on from the question of whether Britain leaves the European Union today. We'll answer that question soon enough and instead look at a question that it looks as though we might be asking ourselves for the rest of our lives, which is when is the Fed going to raise rates? Now, Janet Yellen, the chair of the Fed, testified before Congress today in what's known as the Humphrey Hawkins testimony. It's often a very big event. It was more muted today, but it still produced some very interesting insights. First of all, she chose to emphasize this chart, which we're showing you here, which is the Fed's Labour Market Conditions Index, a composite of a number of different measures of the US labour market. And as you can see, the direction doesn't look good. It's looking as weak in terms of forward momentum as it has done at any point since the Great Recession ended. And that's important because Janet Yellen chose to draw attention to it, said that she needed clear sign of improving momentum before she could raise rates. That was taken as more or less definitively ruling out July as an option to raise rates. Plainly, we can't see a clear enough reversal in that trend with only one set of data to go before then. So that had an effect. If we look at the slightly longer term picture, this, according to the Fed funds futures market, is the chance that we will go without a rate rise at all this year. It's now down to an almost perfect 50-50 shot. There is a sense that people overreacted to last week's Fed meeting, which was more dovish than expected. We still saw that virtually every governor of the Fed is expecting to raise rates at least once this year, and so it is reasonable to think that there is still a considerable chance of that happening. However, as you can see, it's been a very volatile year, but it is still quite remarkable that there is still such a strong chance that rates are just going to stay in neutral for the entire year. Who does this have the biggest impact on? Banks. If we take a look at this final chart, you can see that the big banks have continued to underperform quite severely this year. That is largely because the outlook for rate rises has weakened. Rate rises, at least from levels as low as rates are at the moment, help banks. It makes it possible for them to make more net interest margin. It makes it easier for them to be profitable. If we continue to see the Fed locked in neutral, and particularly if we do get Brexit from the British later this week, which would ratchet up uncertainty and make the Fed that much more cautious, then the horror story for banks will continue. If you want to make an intriguing little bet that the US labour market will strengthen a bit and that the British opt to stay in Europe, you might want to buy banks. But it's the kind of bet that people have been making for a long time, and it continues so far not to work.